We are here with Jamie Knox, partner in the corporate and leverage finance at DLA Piper. Jamie, we've seen a record-breaking month for high new issuances in May, as Treasury yields were at record lows.
Sure.
But as we went into July, and actually June was the month when investors got spooked by the fear that Treasury yields are going to increase as the Fed begins to taper off its bond buying program in September or
Right.
in this fall. And we've seen massive outflows from the high-yield funds. Do you expect this volatility to continue for the rest of the year?
Well, I think people are adjusting really to a new rate environment and the possibility that the underlying reference rates are going to be rising in the future as opposed to the last 10 years where they've been falling with interruptions, but generally it's been a declining rate environment over much of that period. So it's really a chance for the market to readjust to a new baseline, a new normal that folks are going to have to deal with for the foreseeable future, where fixed rate debt is going to be a more challenging asset class in some ways because the underlying reference rates are likely to rise over the life of that debt, and that's likely to have an impact on the valuations of the debt over that lifetime. So that's part of the reason you've seen a break in some ways between the leveraged loan market and the high yield market, where there is more appetite for floating rate debt, which is intended to give some degree of protection even in a rising rate environment, as opposed to the high yield market, which is much more focused on the fixed rate environment.
Exactly, because we've seen the leveraged loan market held in pretty well during this period of volatility. I think we had a strong CLO origination, and as you said, there was an appetite, and from investors,
Sure.
investors are favoring floating rate paper. Do you think we will continue to see a strong demand for loans this year?
I think so. I mean, I think the loan market continues to be an attractive opportunity. And I think if you compare the pullback in the market over the last 6 weeks to the pullbacks we've seen in prior years, both 2011 and 2012, the biggest underlying issue that drove the pullback in the market was concerns about Europe, concerns about the economy itself, underlying credit quality, because borrowers in an adverse economy, their business may be affected. Here, what you're looking at is really questions about valuation and about what this debt will be worth over the life of the loan because of the external rate environment, not because of the borrower's business. And in fact, the fact that we're looking at the possibility of increasing treasury rates is because the economy itself is relatively healthy and the economy is performing at this point. So it's a very different dynamic than the last 2 times there's been a pullback in the market, and that results in folks looking for opportunities and ways to value assets appropriately rather than simply saying, I don't want to be involved in the market because we're concerned about the future and the economy as a whole.
And that's why we've seen borrowers being able to kind of push with Covenantlite deals. They've surpassed 50% of new loan issuance this year, as we've heard in the conference. So what do you think about this deal? We've had some conflicting opinions. Some panelists were saying that actually these deals are not that risky, and there weren't that many defaults if you look
Sure.
at the prior years. And some people who think that probably we are back to the predatory lending, practices of 2007 before the recession.
Well, I think that it's likely that Covenantlite will be here to stay, particularly in the large syndicated market, because I think it is a reasonable deal structure when your investor base is folks who are in the debt and concerned mainly about the valuation of that debt, but don't have an expectation of holding the debt to maturity. I think the tension has always been how far down in the deal size in the market Covenantlite will push, and whether or not Covenantlite terms will really ever take hold in club deals and in smaller deals where the debt is held by one or several banks who do have an expectation of holding to maturity and do want to be involved immediately if there's a problem with the company. So where that barrier lies between deals where Covenantlite is acceptable and deals where it isn't is largely about deal size and to some degree about the type of company that it is and what the ownership looks like. But I don't see anything that suggests that there's going to be a pullback in Covenantlite as a whole or an expectation of financial covenants in deals of all sizes for all borrowers.
There were some new rules, or there's talk about U.S. Regulators imposing a new rule on banks that's going to limit or increase the leverage ratio standards, and that could have an impact on capital, maybe the cost of capital for those banks. Mm-hmm. I was curious if you think that this can impact the competitiveness of the banks when it comes to leverage loans, because I know you represent these banks, or you work with issuers and banks.
Right. I think, again, it will depend on what segment of the market you're talking about, because much of the money flowing in to fund leverage loans is not coming from banks. It's coming from CLOs, it's coming from ETFs, it's coming from mutual funds, it's coming from hedge funds, it's coming from pension money. There are lots of pockets of capital providing liquidity in the market besides the commercial banks themselves. Commercial bank lending is going to have a much more dramatic, changes in commercial bank lending standards are going to have a much more dramatic impact on smaller deals, lower middle market, and individual lender structures as opposed to large syndicated deals. So unfortunately, it's likely the case that the smaller companies are going to bear more of the impact of that. But then again, they're also in a segment of the market where lenders have not extended the leverage ratios and reduced covenants in the way that they have in the larger deals. So there will likely be an impact, but I don't think it will be as significant as some folks may be saying.
All right, I see. And last question, this is more of a jargon in the leverage loan finance about MFN sunset clauses. We've seen this featured in some recent deals. And can you talk a little bit about this? And do you think that the MFN, the most favored nation sunset clause, could lead to the death of MFN? Because it actually limits the MFN to a particular period.
Sure. So, the MFN clause arises in the context of the incremental facility capacity, which allows the borrower to incur additional debt without having to go get permission from the lenders and to add that debt as additional debt into the credit facility. The reason for the MFN clause is because if you incur additional debt at a substantially higher rate, it's going to have a significant negative impact on the valuation of the existing debt. And I think there's a limit to how far debt investors are willing to be essentially crammed down within their own facility by much higher rate debt sitting alongside them. There's a strong logic behind the MFN clause, as much as borrowers might like the flexibility of avoiding it. I think that concept makes sense at some fundamental level. And so while there will be exceptions and there will be times, particularly as you approach the maturity date of a facility, many investors are expecting to hold to maturity and are less concerned about the valuation and the ability to get out of that debt the next day. There may be an opportunity to incur debt without the MFN applying at the tail end of the facility, but I don't expect that clause to fall away as a whole. It serves a purpose and is likely to continue in most documentation for the foreseeable future.
Thank you so much.